So, if you're a trader, you've definitely come across the Relative Strength Index, the RSI. It's simple, it's everywhere, and a ton of people use it. But what if I told you that the way most people use it is, well, it's just plain wrong?
No, seriously, just think about it for a second. Are you one of the traders who sees the RSI pop above 70 and you immediately think sell, or it dips below 30 and you think time to buy? If that's you, you might actually be fighting the market's strongest momentum. And that little mistake, it could be costing you real money. Okay, this slide right here, this is the core of the whole problem. We've all been taught the myth. RSI above 70 is overbought, so you sell. Below 30 is oversold, so you buy. But the reality? It's pretty much the exact opposite. A high RSI like over 70 doesn't mean something's too expensive, it means the uptrend is incredibly strong. And a low RSI just means the downtrend has a ton of power behind it. It's a strength meter, not a reversal signal.
So, the first big mental shift we have to make is to start seeing the RSI for what it really is. It is a momentum indicator. It's not here to tell you when the price is too high or too low, it's here to tell you how strong the current move is.
Yeah, here's the official definition, but let's break it down. RSI measures the speed and velocity of the price. You know what? Think of it like a car's speedometer. If the needle is pointing way over to the right, it doesn't mean the car is about to turn around. It just means you're going fast. Same with RSI. When that line is shooting up, it's telling you the buyers are flooring it. The momentum is huge.
And that leads to this classic mistake. When you sell just because the RSI hits 80, you are literally standing in front of a freight train of buying pressure. You're trying to swim against a powerful current. The much smarter and usually more profitable move is to just go with the flow, not fight it.
Okay, so if we're throwing out overbought and oversold, what in the world are we supposed to be looking for? Well, the answer, and this is the real key to using RSI like a pro, is something called divergences. This is the signal that really matters. So what is divergence? Well, it's exactly what it sounds like. It's a disagreement. It's when the price on your chart is telling you one thing, but the RSI indicator down below is telling you a totally different story. And right there, in that conflict, that's where some of the most powerful trading setups are found.
I absolutely love this analogy because it just makes the whole concept click. Price is the general leading the charge. The RSI, which shows us momentum, well, that's the soldiers. So if the general charges forward and makes a new high, but the soldiers, the momentum, are weak and lagging behind, that's a huge warning sign. The attack is probably going to fail.
Now here's where it gets really useful. Divergence isn't just one signal. It can actually give us a heads up about two totally different scenarios. It can warn us that the trend might be about to reverse, or it can confirm that the trend is strong and likely to continue. Let's break down how you can tell the difference.
Okay, I know this table looks like a lot at first glance, but don't worry, it's your new best friend. For now, just look at the two main categories, regular and hidden. Regular divergence is your heads up for a potential trend reversal. Hidden divergence, on the other hand, suggests a trend continuation. We're about to make this even simpler.
Let's just boil it down. With regular divergence, the price hits a new high or a new low, but the RSI doesn't. That's our general without his soldiers situation, right? It hints at a potential reversal. Now, hidden divergence is the opposite. The RSI makes a new extreme, but the price fails to do so. This is a super strong sign that the original trend has life left in it and is about to keep going.
So how do you actually trade this? It's a pretty clear process. First, of course, you spot the divergence. Now, the most important part is step 2 and 3. Don't jump in right away. You have to be patient. Find a key support or resistance level, and then you wait for the price to actually break through it. That breakout is your confirmation. It's your signal to enter the trade, always with a stop loss and a clear profit target in mind.
All right, you want to make spotting these signals even easier? Of course you do. There are two really simple adjustments you can make to your chart settings right now that will give you a much clearer signal and a serious edge. First thing, go into your RSI settings and change the source from the default close to OHLC/4. What this does is it calculates the RSI using the average price of the whole candle, the open, high, low, and close. It just gives you a smoother, more accurate picture of momentum. And second, do yourself a huge favor and just delete the 70 and 30 lines. Get them off your chart. This will break that mental trap of thinking overbought or oversold. From now on, your new guide is the 50 midline.
And that brings us to this, 50. This is your new magic number. It's so simple, but it's incredibly effective as a quick trend filter. If the RSI is hanging out above 50, you're in an uptrend. If it's living below 50, you're in a downtrend. It's a fantastic, at-a-glance way to understand the market's bias.
Look, we've gone through a lot here, rethinking what RSI means, spotting divergence, even tweaking your settings. But if you remember just one thing from all of this, please let it be this next point. And here it is, the golden rule. RSI divergence is not a crystal ball. It's a confirmation tool, a powerful one, but it is not a standalone strategy. It tells you, hey, pay attention, something might be about to happen, but it does not tell you when to pull the trigger. Always wait for the price itself to confirm what the RSI is hinting at. Pair that divergence with a broken trend line or a busted support level. When all those things line up, that's when you've got something special.
So learning to use the RSI correctly means we have to break that old overbought and oversold rule we were all taught. And that kind of makes you think, doesn't it? What other common trading rules are out there that might actually be holding us back? Definitely something to chew on.